Learning the critical period concept is very important if you're going to be profitable and in the end successful with Symmetry. Many of the families you sit with will be in their 30s, 40s, and 50s and in pretty good health, and this usually allows for affordable coverage with larger face amounts, and these clients can easily see the value in what you're showing them. But how do you handle older clients, say in their 60s, 70s, or 80s, or even younger clients that may have some health issues? This can be tricky because the cost for larger face amounts will be much more, oftentimes making that coverage amount unaffordable. For example, what do you show a client that is 66 years old, has a few health problems, and has a mortgage amount of $175,000 that they would like to cover? This scenario will come up, especially if you're working mortgage protection leads. And you'll be forced in scenarios like this one to look at coverage that is generally used for final expenses. These are those whole life policies with face amounts of only $5,000 to maybe $35,000. Now, sometimes it is a little harder for these clients to clearly see the value in a face amount that doesn't even begin to cover the mortgage amount. So it's up to you to help them see the value in this coverage. You can do this using the critical period concept. The good news is that we have a script to help you do this. So I'd like to just read this script, and by doing so, you'll start to understand how to handle these situations and walk away with happy clients. Keep in mind that my job is to get you what you qualify for and not get you declined for coverage. With mortgage protection, there are really two options. There is the mortgage payoff plan, and unfortunately, John, in this scenario, it will be hard to get you qualified for that option. And even if I could, it could end up costing you more than your mortgage payment. Now, the second option is very popular with homeowners in your situation, and it's a lot more affordable. It's what they call critical period coverage, and it's designed to cover the most critical period of time after the loss of a spouse or a loved one when the remaining spouse is at most risk of losing their home. Let me explain. John, if something were to happen to you tomorrow, heaven forbid, does the bank come to Mary and ask for the full $150,000? No, they just want the next mortgage payment. People go into foreclosure not because the bank wants the payoff, but because the bank wants the payment. And it would be nice if the bank would call you up and say how sorry they were for your loss and offer to waive your mortgage payments for the next 6 months to a year, but that's not how it works, is it? So what this policy is going to do for you is it's going to buy you time. Most importantly, time to grieve properly. The last thing we want for Mary is to be at the funeral worried about the next mortgage payment. It also gives you time to make a plan. If you need to refinance or even sell the house and downsize, then you can do that. Let's face it, houses aren't exactly flying off the market right now. So this option would give you the time you need to sell the house for what it's worth rather than taking a loss to sell it quickly. And doing that will protect the equity that you guys have worked hard to create in this home. You see, guys, if you have the time to protect your equity, then your equity can become your death benefit. So this is going to be a much better option because, one, we can actually get it, two, it's more affordable, and three, this is a permanent insurance plan, which means if we qualify, you are guaranteed to receive benefits as long as you pay the premiums. Does this option make sense to you guys so far? If so, let's see how much time we can buy Mary in this case. So here we're using an example of a client that has a $600 mortgage payment. So if that's the case, you can show them three options. Option A is a $35,000 death benefit. But that is 58 months of payments or 4.8 years of mortgage payments, and that cost is $350 a month. Option B would be $25,000 of death benefit. That is 3.4 years, and that cost, and again, these costs are hypothetical, just examples of cost. That cost is $220 a month, and option C could be $15,000 of death benefit or 2.1 years of time for Mary, and that cost might be $140 per month. So which option best suits you would be your next line here. Now, if option C is still too high, keep going until you find something that works. It's not uncommon to sell 3 to 6 months of mortgage payments if that's what fits the budget. Something is always better than nothing. As you can see, this script can be very effective in helping clients see the value in smaller amounts of coverage. So instead of showing them the mortgage payoff option, we can show them the mortgage payment option. An important phrase you'll hear us use is, it's not what it is, it's what it does. See, it's just $20,000 of coverage. That may be what it is, but what $20,000 does is keep a roof over the family's head during the most critical period of time after an unexpected death, the time that they're most likely going to experience the brunt of financial hardship. So, Learn this concept well, and you'll help more families. And that's the name of the game. Now, go protect that family using the critical period concept.